On April 23, 2023, Bed Bath & Beyond filed for bankruptcy, marking the end of a 52-year journey that saw the rise and fall of one of America's most iconic retail giants. Established in 1971, Bed Bath & Beyond quickly became synonymous with home goods and those iconic blue coupons that flooded mailboxes nationwide. By 2011, the company had reached the zenith of its success, valued at nearly $14 billion, with over 1,500 stores across the United States. But beneath the glittering facade of success lay the seeds of its demise: aggressive stock buybacks and the allure of meme stocks. The story of Bed Bath & Beyond began in Springfield, New Jersey, where founders Warren Eisenberg and Leonard Feinstein opened the first store. Their vision was simple, yet profound: offer an expansive selection of home goods at competitive prices with exceptional customer service. This model resonated deeply with consumers, and by the late 1990s, the company had expanded to hundreds of locations nationwide. The brand became a staple in the American shopping experience, known for its vast selection of kitchen gadgets and bedding essentials. From 2004, Bed Bath & Beyond embarked on an ambitious stock buyback program, spending over $11.73 billion over the years. This strategy, while boosting stock prices temporarily, siphoned off critical funds needed for innovation and adaptation in a rapidly changing retail landscape. The retail industry was undergoing seismic shifts with the rise of e-commerce giants like Amazon. Yet Bed Bath & Beyond seemed content to rest on its laurels, focusing on short-term stock performance rather than long-term sustainability. By 2019, under the leadership of CEO Mark Tritton, the company doubled down on this strategy, executing a $1 billion share buyback. Tritton, a former Target executive, was brought in with hopes of a turnaround. His focus on private labels and store closures drew criticism and ultimately failed to revive the company's fortunes. The decision to close underperforming stores and streamline operations was meant to cut costs, but led to a loss of customer loyalty and market presence. In 2020, the world was gripped by a pandemic, and the retail world was turned upside down. Amidst this chaos, a new trend emerged: meme stocks. Driven by retail investors on platforms like Reddit's Wall Street Bets, these stocks saw unprecedented volatility. For Bed Bath & Beyond, this surge was a mirage. In July 2022, their stock price was languishing at around $5. By mid-August, it had skyrocketed to nearly $30, fueled by the collective frenzy of meme traders. Yet this surge was built on speculative sands, disconnected from the company's deteriorating financial foundations. As the festive season of 2022 approached, Bed Bath & Beyond found itself in dire straits. November reports revealed a 42% increase in quarterly losses, despite the Black Friday rush. Sales dipped by a third, signaling trouble ahead. The meme stock frenzy had provided a brief respite, but the harsh reality of plummeting sales and rising debts could not be ignored. Analysts were vocal in their warnings, describing the meme stock rally as backed by little more than speculation. The company's stock price, once a darling of retail investors, was now in freefall, plummeting approximately 97% from its highs. The human impact of Bed Bath & Beyond's collapse was profound. Thousands of employees, many of whom had dedicated years, if not decades, to the company, found themselves jobless overnight. Behind every shuttered store was a story of personal loss and uncertainty. Suppliers and landlords scrambled to fill the void left by vacated stores, while shareholders faced devastating losses as the stock's value evaporated. Many small towns and communities, where Bed Bath & Beyond was a key retail anchor, faced economic ripples that extended far beyond the loss of a single store. At the heart of the collapse was a fundamental misstep: the $11.8 billion spent on stock buybacks instead of investment in growth and adaptation. This decision, more than double the $5.2 billion debt at the time of bankruptcy, was a critical error. The rise of meme stocks provided a temporary illusion of prosperity, but could not mask the underlying financial instability. As consumer preferences shifted and online retail giants gained ground, Bed Bath & Beyond failed to adapt, sealing its fate. The aftermath of Bed Bath & Beyond's demise extends beyond its own unfortunate end. It serves as a cautionary tale to other retail giants navigating the turbulent waters of the modern market. In an era defined by rapid technological advancements and shifting consumer behaviors, clinging to outdated business models can prove catastrophic. The story of Bed Bath & Beyond is a stark reminder of the perils of prioritizing short-term stock performance over sustainable business practices. The meme stock phenomenon, while exhilarating for some, proved to be a fleeting distraction from the company's core issues. In the end, the combination of aggressive buybacks and the unpredictable influence of retail investor sentiment spelled the end for this once thriving retailer. It underscores the importance for companies to remain vigilant, adaptable, and forward-thinking in their strategies. As we reflect on the rise and fall of Bed Bath & Beyond, the lessons are clear. In the volatile world of retail, adaptability and foresight are key. Companies must invest in innovation and embrace change to survive. The tale of Bed Bath & Beyond is not just about financial missteps, but about the human cost of corporate decisions and the unpredictable forces of the market. In the end, it is a cautionary tale for businesses and investors alike, a reminder that the true measure of success lies in building a resilient and adaptable business, able to weather the storms of an ever-evolving marketplace.